started investing in it?
At the time, it was in the ballpark of around $5 per share.
Okay. And in your analysis, what did you think a proper price for the share was? Because you thought you were getting a good buy.
Sure. At the time, I thought that the value of the business could be worth up to roughly $2 billion.
Okay, but how much is that per share? Just let's bring it back to you bought at 5, you thought it was worth 10, 20?
I felt as though that it could be worth at the time in the range of, say, $20 to $25 per share.
Okay. And you continued to invest on and off through 2019 and 2020. Is that true?
Yes.
Okay. And you also you bought some shares, but you also did some options trading, did you not?
Correct, I did.
And options trading is not really for the novice investor, is it?
It is a riskier investment, yes.
Okay. On January 27th, I think the stock price hit $483 or something like that. Is that true?
I believe it was in that area, yes.
In your analysis, back when you started investing in the stock, did you ever see it being valued at $483 per share?
At the time, I thought it was possible, but a very low probability, I thought.
Okay, thank you. Just a couple more questions. In terms of the platforms where you visited and discussed this stock with others, one was the Reddit subreddit Wall Street Bets platform, correct?
Correct.
And at any given time, how many people were you talking to on that platform?
I wasn't so much talking to anyone individually, but rather making posts on that public forum.
That GameStop was an attractive stock.
Yeah, early on, I had felt that it was an attractive investment opportunity, and I had shared some of my thoughts as to why that was.
Did you discuss this on any other platforms? Are there any other kinds of Reddit or other kinds of platforms that you talked about the stock?
Yes, I have talked about the stock on some other platforms.
Okay. Did you ever talk about the short sellers that had bet against this company?
Yes, the topic did come up.
And about when did that occur?
Oh, since around the time I had begun investing in it, it was, as someone else has noted, it was an exceptional level of short interest in the stock since the time I had started investing in it.
Okay. Let me turn my attention now to you, Mr. Plotkin. When did Melvin first take a short position in GameStop?
Thank you, Congressman. That was in 2014, really right at our inception of the fund.
And when you did that, did you continue to maintain a short position?
That's correct.
So you said you analyzed the value of the stock, and you, by taking a short position, you, unlike Mr. Gill, thought that the stock was overpriced. He thought it was underpriced. You thought it was overpriced.
That's a good conclusion. Yes.
Okay. In your analysis, when you started into the short position, what did you think the stock was worth?
I don't remember exactly at the time. I think when we launched, it was probably a $40 stock. I think we believe the company had a lot of structural challenges. We've seen their earnings go from, I think, north of $3 a share to almost negative $3 a share. So there's been a lot of challenges fundamentally.
All right. Last question for you. Were you in a naked position in your short position because the stock was oversold?
No, our systems won't even allow that. So that would be impossible for us to do.
Okay. Well, thank you. My time's expired. I wanted to get some facts out for Mr. McHenry, and I yield back.
Thank you very much. The gentleman's time is expired. Mr. Emmer?
We thank you.
Nice for 5 minutes.
Thank you, Madam Chair, Ranking Member McHenry, for holding this hearing. Thank you to the witnesses for being here today. I represent the 1st Congressional District of New York, which encompasses much of Suffolk County on Long Island. My home district is full of people from all different walks of life and industries, and having access to cost-efficient investing is crucial. While there are always ways to make a system work better, our capital markets are the envy of the world with their liquidity and diversity of investment opportunities. Innovations in securities trading brought by the private sector have increased access for retail investors. For better or for worse, and this situation is a perfect example. For example, one of our witnesses here, Mr. Gill, or should I say Roaring Kitty, turned $53,000 into almost $50 million, and that's what you would call some deep you-know-what value. Of course, we know that not all those who invested in these stocks share the same success story. However, I want to highlight a potential vulnerability in these innovations. I've been concerned for some time in general with the sharing of US individual user data with the Chinese Communist Party. I sent a letter, for example, to the Treasury Department in October 2019 expressing concern with the potential sharing of user information by TikTok to its parent company ByteDance and asked for a CFIUS review. Chinese companies are required by law to regulate online behavior that deviates from the political goals of the CCP, obey the CCP's censorship directives, and participate in China's espionage. These policies regulate companies like TikTok in the China market and increasingly their overseas business. Webull and Moomoo are 2 examples of broker-dealers that are subsidiaries of Chinese parent companies. According to Bloomberg, funds affiliated with GME Corp own at least 14% of Webull. GME is a Chinese company that risks being delisted from US exchanges after the US Department of Defense put the company on a blacklist on January 14, 2021. Moomoo is owned by Futu Holdings, which is a company that received a significant investment from entities affiliated with Tencent, a company with known ties to the CCP. On December 8, 2020, Bloomberg Businessweek ran an article on Webull stating the company, quote, has increased its roster of brokerage clients by about 10-fold this year to more than 2 million by offering free stock trades with a slick online interface. On January 29, 2020, the day after trading activity for long trades on certain stocks discussed on Reddit threads were limited, Bloomberg ran an article with the headline, Robinhood rival Webull sees 16-fold jump in new trading accounts. It's clear that these apps have rapidly increased their user base, which has me concerned. Ms. Schulp, do you think we should be concerned about the potential for Chinese entities with ties to the CCP receiving personally identifiable information or other user data from their subsidiary broker-dealers that are licensed and registered in the US?
I think it's a potential national security concern, which is a bit outside of my area of expertise. What I can say is that the rules that the brokers have to apply and comply with regarding personally identifiable information and other material data should be applied equally to companies that are based offshore and companies that are based onshore. And I hope that that's the case with respect to Webull or any other competitors that are not domestically owned.
Having a diversity of choice for different trading apps is generally good for market competition. However, is it a good outcome for millions of Americans to flood into trading apps that could be required to share user data to parent companies that have ties to the CCP?
Again, I think choice is key here, as well as understanding from a consumer perspective what companies you are choosing to do business with. Again, the national security concerns are a bit outside of my area of expertise.
Well, I thank you for being here. This is another angle to this issue with these new options that are being provided to average retail investors. And we want these retail investors to have the most amount of information as possible to be set up for success. I yield back.
Thank you very much. Mr. Himes, you are recognized for 5 minutes.
Thank you, Madam Chair, and a big thank you to our panel today for a very interesting conversation. One of the chairwoman's ways of characterizing this hearing was who wins and who loses. And I've spent a bunch of time in the last couple of days looking at the various players here. I'm pretty convinced that the wholesalers, Citadel is one of the winners. They make a lot of money. They're the casino in this story, and the casino tends to win over time. Robinhood has a valuation of $5.6 billion and makes a lot of money from the casino. So who loses? And I want to spend some time talking about the person who usually loses, and that's the retail investor. And while I have supported for many years the democratization of finance, as we say, it's not just in Washington, D.C., but on Wall Street. The retail investor is known as dumb money. And there are any number of structures that are set up to take advantage of the retail investor. And I think it's worth looking at that because as much as we're celebrating Mr. Gill here, we're not talking very much about Mr. Salvador Vergara, who was featured in a Wall Street Journal story, who took out a $20,000 personal loan through Robinhood, invested it in GameStop, only to see the value of his position go down 80%. So Mr. Vergara is out $16,000 he doesn't have, that he owes to somebody else. And as much as I support the democratization of finance, we need to be thoughtful about this. So Mr. Tenev, my question is for you. You quoted a $35 billion number as what I interpreted to be profits in excess of deposited funds and securities. If you just look at your customers who traded in GameStop over the period of its increase and subsequent decrease, Mr. Tenev, how did your customers in the aggregate do? Did they win or did they lose?
Thank you, Congressman, for that question. I don't have that particular cut of the data top of mind, so maybe we can get back to you on that one.
All right, you don't have that. So you do have a $35 billion figure. The figure doesn't mean a lot to me because it's just a dollar number. Help me convert that to a rate of return. First of all, is that $35 billion, is that gross or net? In other words, is that actual profit or does it include margin shares, other forms of leverage that may actually not belong to the account holder?
It does include, Congressman, unrealized gains. So it's the value of assets, both including positions in securities and cryptocurrencies.
Okay, I get that. I get that. But again, 35 billion doesn't mean anything to me unless you can convert that into a rate of return. So do that for me. What is that on what asset under management number is that 35 billion unrealized against?
The asset under management number is not one that Robinhood has publicly shared.
Okay, but you can't share $35 billion. Sorry, Mr. Tenev, I just don't have a lot of time. $35 billion is a meaningless number. I need to know what that is in terms of return. So convert that for me into rate of return. So I can compare it to Treasury, so I can compare it to the S&P 500.
Congressman, with respect, I think the proper comparison is to customers not investing at all. Much of our customers are investing for the first time and are taking money that they otherwise would have spent or consumed and putting it in.
Mr. Tenev, again, I don't want to be rude, but it's my time. Again, you offered up the $35 billion number, which, as you and anybody else schooled in finance knows, is meaningless unless you convert it into a rate of return. So just please convert that $35 billion number, which to the folks watching at home sounds like a lot of money. But what does that actually convert to in terms of rate of return, which is what matters?
Congressman, $35 billion is indeed a large amount of money, especially for our customers who are mostly small investors. It's more than most corporations, nearly all corporations have paid.
Mr. Tenev, again, don't make me be rude here. You and I both know that $35 billion of unrealized gains, if that's on a base of $100 billion, that's a 35% of return. If that's under $1 trillion, it's a radically different rate of return. So what I'm trying to get at, Mr. Tenev, here is you threw out the number of $35 billion. I actually think the right comparison is, what if your clients had simply invested in the long run in an S&P index fund? Would that number be more than $35 billion or less?
Congressman, with respect, I don't believe the right comparison is investing in an S&P index fund. I think the right comparison is not having invested at all and having instead spent that money and consumed it.
No, it's most certainly not. It's most certainly not, Mr. Teneth. And so I'm going to ask you. I'm out of time, but again, you put out the $35 billion number, so I think it's only decent because you and I both know that a hard dollar number is meaningless unless you can convert it to return. So I'm going to ask you to convert that. Obviously, I'm out of time into a rate of return for us.
You're out of time. Mr. Laudermilk, you now recognized for 5 minutes.
Thank you, Madam Chair, and I appreciate all the members of the panel being here. I think you've seen that there are occasions with some on the committee here that if you're not giving them the answer that they want that they can use, they're just going to continue to push on you. And I just encourage you to continue speaking the truth, and you'll always stand up head and shoulders above everyone. Not surprisingly, the situation with GameStop trading has resulted in commentators and even some of my colleagues engaging in knee-jerk reactions, calling for new laws and regulations to be hastily enacted. It just seems to be a trend in Washington, D.C. to never let a crisis go to waste. Some have even spread conspiracy theories and alleged that crimes were committed before knowing what even happened. I can even testify to what was just being said is I know numbers of people, personal friends who have never invested before, but because of Robinhood and other retail platforms, many of them took the stimulus money that they received during the CARES Act, which they were still working, they didn't need, and they actually started an account and started investing. So yes, more and more people who have never invested before are now investing using these platforms. This hearing is a reminder that with complex situations, we should take time to understand what actually did or did not happen, especially with this GameStop situation. Now, the SEC is the proper authority to determine if any rules were broken, and they are looking into it. Congress has already given the SEC broad authority to oversee the capital markets, and we do not need to rush to enact even more big government regulations until that could ultimately harm the investors. Now, question, Mr. Teneth, can you remind us again why Robinhood temporarily paused trading of GameStop and other stocks?
Of course. Thank you, Congressman. Robinhood paused trading temporarily, or I should say paused buying of about 13 securities on Thursday so that we could meet our regulatory deposit and collateral requirements.
Okay, so what you're saying is you were paused because you had to comply with regulations. Is that true?
Correct.
All right, so it's ironic that the people who are criticizing brokerage firms because they pause trading, which they sometimes have to do to comply with regulations, these same folks are now saying, we need to respond to this with more regulations. I would say if people don't like brokers occasionally having to pause trading, I'd suggest they look at the regulations that required it. At some point, we need to recognize that piling on more and more regulations only increases complexity and does not help investors. Question for Ms. Schultz. Despite the volatility and the frenzy of media and social media activity, it seems to me like the markets functioned as they were supposed to during this situation, and that markets are not broken. In fact, they are working well. Do you agree with that?
I agree with that.
Okay, thank you. I appreciate that. I think most reasonable people that are listening to this would agree that there are regulations in place. The SEC has those to pause activities that could be harmful, not only to the markets, but to the individual investors. And so what I'm understanding you saying is that it did work in the way it was supposed to.
As the facts that I know now, it does appear to have worked the way it was supposed to. This is not a sign to me that the market is broken.
Thank you. Mr. Griffin, what are some of the issues that policymakers should consider in the T+2, T+1, T+0 debate? Obviously, margin requirements exist to make sure firms have enough capital to settle transactions, but faster settlement and lower margin requirements can be positive for the retail investors, and we need to balance those needs. Can you address what some of the issues are in the T2, T1, and T0 debate?
So, Congressman, I cannot profess to be an expert on these issues, but I will give you my perspectives from having been in the industry for 30 years. We started at T5. We will one day be at real-time settlement. And the question is how long does that journey take? From T2 to T1, which reduces the amount of capital required by broker-dealers to meet the needs of their customers, that reduction in capital will be meaningful, would have been very helpful to Robinhood during this period of time. Reduces counterparty risk holistically, which is good for everybody in the market. We should push for T1. As we go to same-day settlement, you now bring into question the complexity of intraday cash movement, and you bring into play the necessity for all systems to be functioning every moment of every day with no room for error. At a T1 settlement cycle.
Gentleman's time has expired. Let me remind the members that we're going to have a series of hearings. Today is the first. There will be probably two more. I didn't hear anyone here today say that they were ready to pile on regulations. So let's make sure we know that our statements are accurate. Mr. Foster, you're recognized for 5 minutes.
Thank you, Madam Chair, and to our witnesses. Mr. Tenov, I'd like to follow up a little bit on payment for order flow and best order execution issues. Democratization of finance is a good and noble goal, but for democracy to work, consumers need transparency and high quality information, and not only about fees, but about order execution quality. Your customers actually don't care directly about who you subcontract order execution to or any payment for order flow, but they need a simple way to compare the execution quality between your app and competing apps or other accounts. And while institutional investors can afford to run their own tests, and they do, and I'm sure Mr. Griffin is normally is quite often on the receiving end of those tests and trying to measure up to his competitors to compete for market share there. The institutional investors have the market power to demand best execution statistics for their prime brokers. And everyday investors do not get the same transparency. In fact, I believe there's an SEC rule 606 that requires brokers to disclose at least some order execution data to institutional investors, but this requirement does not apply to retail investors. So, Mr. Tenov, since Robinhood's mission is to democratize finance for all, I ask, what are the mechanisms that you would accept and support to provide transparent order execution quality statistics so that your customers can engage in a clean apples to apples comparison between other brokers, between your app and other people's apps in terms of the total cost of trading?
Thank you, Congressman, for that very important question. I'm generally in favor of a greater amount of transparency than what we've typically seen in the financial industry. And recently, Robinhood and me personally have engaged publicly on the topic of payment for order flow, short selling, and of course, T+2 and real-time settlement. We do publish 606s via Robinhood Securities that detail our payment for order flow arrangements with various market makers. And just this past year, the industry implemented more detailed 606 requirements, which we of course conform to. Also, back in December of 2020, we released a public page on our website that provided detail about the execution quality, including price improvement that our customers received. And we're proud to announce in 2020, our customers received in aggregate over $1 billion of price improvement on their executions.
Right, but that's not a comparison to your competitors. There are a lot of questions about the accuracy of the best execution reference price. And independent of whether it should be improved, it seems like if I was a customer of you or one of your competitors, what I'd want to see is, I just executed a trade of $2,000 and on average, I got X% better or worse than a reference price. And then over time, and see not only the trade that I just executed, but perhaps a running average over the last month or two that you can compare to the running average of whether you're exceeding some benchmark for trade execution quality. that can really be compared with potential competitors. And is that a workable system? Are there difficulties? Is there a reason why industry shouldn't move that way in the name of transparency to customers?
Congressman, this is a very interesting topic to me. I'd love to have the conversation. I don't know if this is the right forum to necessarily ideate and brainstorm on all the solutions, but I just want to say I'd be happy to engage with this in a detailed forum and figure out the right path.
Okay, well, yeah, we do intend to continue to engage with the industry on this subject, because it's very easy to make payment for order flow sound really creepy. You're basically selling a list of rubes to the sharks. Okay, on the other hand, you make part of an argument that this can net out positive for consumers, but for it to fully net out positive, they have to be able to make the apples to apples comparison. And so that's, I think really an important issue. And I think that probably your reaction to that, if you found your customers were leaving you because of poor execution quality, you would do what large funds do, which is to split your order flow between multiple order execution firms, and then demand of them the best order execution, and move your business to whoever does the best for your customers.
Yes, well, Congressman, we already do that. We have 7
Time has
market
expired. Mr. Mooney, you're recognized for 5 minutes.
Thank you, Madam Chairwoman. So let me just start by saying that last Congress, 30 of my Democrat colleagues, 4 of whom on this very committee, co-sponsored a bill that would impose a financial transaction tax on the purchase of securities and certain derivatives. And just recently, after the market volatility surrounding GameStop in January, Democrats renewed the call, many Democrats anyway, renewed the call for a financial transaction tax. On just January 28th, Congresswoman Ileana Omar tweeted, "How about this? Financial transaction tax now." Congressman Peter DeFazio is the lead sponsor of the bill. He's already put the bill back in for this session of Congress. It's now House Resolution 328 of 2000. So it's called the Wall Street Tax Act of 2021. I actually have a copy of it from the last session here. It's in again now. And he says, Congressman DeFazio says that a financial transaction tax would, quote, help create a more level playing field for Main Street. So with that background, Mr. Attentive, this question is directed at you. The Robinhood platform has more than 13 million users, and most of them are small dollar retail investors. If the federal government levied a 0.1% transaction tax on the sale of securities, and I know one of my colleagues, French Hill, my good friend, mentioned this earlier, but I want to expand upon it a little more. How would that 0.1% transaction tax on the sale of securities affect your platform and the retail investors that are your customers?
Thank you, Congressman. And we'd be happy to engage in this discussion much more in the future. A 10 basis point financial transaction tax would eat into the returns of our customers, which, as you pointed out, are largely smaller investors. And in that sense, it would be a cost to the retail investor. Of course, that would have to be weighed against the potential benefits of this tax. And I know it's a more complicated issue than meets the eye at first glance.
Okay, well, thank you for that answer. My next question is actually for Jennifer Schlupp. I know you spent your career specializing in financial regulation. In your expert opinion, would a financial transaction tax directly prevent fraud or market manipulation?
No, I don't think a financial transaction tax would have an effect on fraud or manipulation. I also don't think that it ultimately, financial transaction taxes often fail to raise money, and they distort trading in a way that's not necessarily foreseen initially by the tax. And I'd like to just add in there as well that financial transaction taxes, while they initially might seem like a small imposition on an individual investor, those taxes often hurt individual investors and their long-term retirement goals by affecting the institutions that also do the trading in mutual funds and with retirement money.
And the,
I don't think a financial transaction tax is a good idea.
And a quick follow-up to that, Mr. Slup, what do you think a financial transaction tax would have done anything to prevent the market volatility and disruption we saw just this past January?
No, I don't think it's related here. There's been some discussion that it might have decreased the amount of trading and thus changed the volatility. It's not my opinion that that would have had any effect on this particular circumstance.
Thank you. I only have a minute left, so let me just summarize. The financial transaction tax supported by many Democrats would do nothing to prevent market manipulation or fraud, would have not prevented the market disruption in January, and most importantly, would hurt retail investors. Yet Democrats are claiming that the events surrounding GameStop and Robinhood in January make it imperative to implement this financial transaction tax. It just doesn't add up. A financial transaction tax would make it more expensive for small retail investors to trade. And so much for looking out for Main Street. I believe we should be working together to find ways to open up markets to retail investors, not close them. Instead of making trade more expensive with a burdensome tax, let's look for ways to empower retail traders. Thank you, Madam Chair. I yield back.
thank you very much. Ms. Beatty, you're recognized for 5 minutes. Ms. Beatty?
Thank you,
Unmute.
Madam Chairperson, and thank you to the witnesses. My first question is to the CEO, President Ken Griffin. In the first 3 quarters of 2020, your company paid online brokerages like Robinhood $700 million for their order flow. Do you believe that brokers like Robinhood can serve as the best interest of their users while selling their order flow to companies like yours? And that's yes or no.
Congressman, I believe that Robinhood actually goes further in meeting the best interest of customers by, in fact, routing their order flow to Citadel. We give a better price, a better execution for American retail investors than the alternative of going to exchanges.
So I'm going to take that as a yes, since you said they go further. Then can you tell me, why did your company urge the SEC to ban the payment for order flow models in a filing to the SEC?
Congressman, that is a terrific question. That filing relates to the U.S. options market. It was a filing back, I believe, in 2004. And in the U.S. options market at the time, trades were committed against listed quotes. We were apprehensive about the direction in which the U.S. options market was heading towards the existence of these price improvement auctions, which diminished the incentives to aggressively provide bids and offers in the options market. We felt that legislative or regulatory efforts to encourage tight quoting, to discourage the existence of these auctions, and this was being, in some sense, fueled by a series of payment for order flow programs, was in the best interest of American institutional and retail investors. Now, regretfully, we did not prevail in our reasoning. The rise of price improvement auctions came into, in essence, the day-to-day model for options trading in the United States. And I do believe that this is a setback for our capital markets.
So because my clock is ticking, let me ask you this. So are you saying that you no longer believe that the model is anti-competitive and distorts order routing decisions?
I think it's important to distinguish between a market where you must trade on an exchange. In the options market, we must print the trade on an exchange, versus a market where you can trade off exchange, which would be the U.S. equities market. So just to be very clear, because your question is very good, every single options trade must be executed on an exchange. Equity trades do not. And because of that, I can save Robinhood exchange fees and offer a tighter bid-ask spread
Okay,
than the
clearly
one
we're going
set.
to have a further discussion. Let me interrupt you only because my time is clicking and I want to follow up with a question for Robinhood's CEO. Several of the brokers offer their users order flow for the sale to the firm, like with the previous CEO with Citadel. However, the price that Robinhood gets for the order flow is much higher than any other brokers receives. And I could go on and tell you we've pulled the SEC filings that Robinhood receives 17% per 100 shares stock of traded and 58% to 100 shares, and I could go on. But the question is, why do companies like Citadel pay a premium for their order flows of Robinhood users?
Thank you, Congresswoman, for that very important question. There's several reasons that may be the case. One important one is that our model and formula for payment for order flow works a little bit differently. We actually receive payment for order flow as a percentage of the bid-ask spread rather than on a per share basis. And we do believe that that's the most optimal way to structure payment for order flow arrangements.
Okay, is it not because companies like Citadel can make more money off of Robinhood users than others? And that's a yes or no, because my clock is going to run out.
No.
I'm sorry, I yield back. My time is up.
Thank you very much. Next, we will have Mr. Vargas. Excuse me, no, Mr. Davidson next, and then Mr. Vargas. Mr. Davidson, you're recognized for 5 minutes.
Thank you, Madam Chairwoman. I thank our witnesses. I appreciate the work you've done today. And I just want to share that in May of 2020, the Depository Trust Clearing Corporation unveiled a working proof of concept called Project Ion. In this project, DTCC said they would examine the potential use of distributed ledger technology in accelerating the clearing and settlement process. Now, since Project Ion was publicly announced, we've received little information pertaining to its progress. As a longtime advocate for this emerging technology, distributed ledger technology and blockchain, today I've sent a letter to the DTCC to request that they provide an update on the status of Project Ion. And I look forward to hearing back from them. Hope to include them in our next hearing. Mr. Griffin, with Project Ion in mind, could you briefly state what would be your biggest concern if DTCC implements same-day clearing and settlement?
Same-day clearing and settlement requires that every bit of the workflow is perfectly synchronized across all parties, and we have no time for recoverability or for error management that you have in an overnight batch process.
Right. So the technology makes that essential. In my assessment, and many that is inherent to the architecture for blockchain to move forward with each proof. And so I guess clearly in your business, just to follow up there, the technology exists where, for trading firms that are engaged in high frequency trading, you measure success in the course of the day in what, milliseconds for high frequency trading?
So as you know, we are the largest market maker in the world and the largest in the United States in equities. We put great emphasis on the performance of our systems. That was one of the reasons that on the week of January 24th, we were the only major market center for retail order flow that was responsive every minute of every trading day.
Perfect. So I just wanted to make the point that I think the technology exists, whether you use blockchain or not, and applaud you for having the ability to execute with precision swiftly already. And I don't think it's a barrier. And I'd love to have more dialogue, but unfortunately I have to go to a few others. Mr. Tenev, do you believe that the root cause of January 28th for the problems that you and others experienced were market infrastructure related, particularly related to T2 versus T0?
I believe, thank you, Congressman. I do believe if we had real-time settlement capability and the infrastructure was modernized, we would not have seen similar problems.
Yeah, and thanks for that. I think, one of the related things, and it's related to your mission at Robinhood of more democratic access to capital, is not just the ability for more people in a broader portion of America to become savers and investors. It's also to engage in corporate governance even. So do you believe that if market infrastructure would guarantee, and this is really related to, the over, musical shares where someone could be left with no share when the music stops, multiple claims on a shorted stock. If the market infrastructure would guarantee an investor could retain custody of their shares so that the shares can't be lent to short sellers, there could be a downside. How do you feel that only one claim on the shares would resolve this? And that relates to proxy voting as well, or shareholders voting the shares.
Congressman, I believe that that's an important question. It's one that Robinhood and me personally have engaged with. I do believe that the ability for the same share to be shorted an indefinite number of times is somewhat of a pathology, and that should be fixed. And I think step one of that is modernizing the antiquated settlement infrastructure that everything is built on. We simply don't have the ability to properly track what shares have been shorted and how many times as they're moving through our settlement system currently.
Yeah, thank you for that. And I appreciate that you see the relationship. Hopefully broadly we do, and we provide that nudge the market needs. I want to commend Vice Chancellor Travis Laster of the Delaware Chancellery Court for his letter and paper, The Blockchain Plunger, which explains how this could be done. And I ask unanimous consent to submit that to the record. As my time expires, I want to commend you, Mr. Gill, for just representing a large segment of the industry, in my view, where savvy investors have had an opportunity to engage. And it relates to people with diamond hands that hold. So you might not call yourself a holder, you might use the word diamond hands, but thanks and congratulations for your success.
The gentleman's time has expired, and without objection, your submission is taken. Thank you. Mr. Vargas, you're ready.
Thank you very
minutes.
Thank you very much, Madam Chair. First of all, I want to apologize to Mr. Plotkin. You spoke of the anti-Semitic attacks that you suffered online, and as a person of color, I always feel the need to confront hate speech and speak out. And I don't think there's ever been a more hateful, evil, sinful event in human history than the Holocaust. So I want to apologize to you and your family for those attacks. You brought it up, and I think we owe you an apology. I want to apologize for that. Sometimes I think some of my colleagues on the other side of the aisle are devoid of any contact with real people when they say this is just political theater, or they don't want to know the rate of return when that's exactly what people want to know. In fact, there's been a great deal of interest in this hearing, and I think it's because there's great distrust in our society and in government, markets, institutions. And then along comes this story of GameStop. And it's a story really of Robinhood turned on its head. And the reason I say that is that Mr. Zuckermeyer brought it up. Robinhood is an English folk hero, 13th, 14th century. And he was supposed to steal, Robin of Locksley was supposed to steal from the rich and give to the poor. And here you almost have the opposite. You have the situation where you have the steal from the small retail investor and giving it the large institutional investor. From an outsider's perspective, you have the bullies, the hedge funds, and their armies of analysts and lawyers and regular old suits attacking the trust GameStop by shorting its stock. And then to rescue, here comes the retail investors, and they're taking stock to these incredible levels. And all of a sudden, Robinhood steps in, but not to help the little guy. He steps in and says, I'm going to help the big guy, and stops the sale because no one knows how high this is going to go. And who's getting it? Who's getting socked in this thing? The bullies are the hedge funds. And that's why people were excited about this. But all of a sudden, Robinhood steps in and they say, no, we had to do this because of other conditions. And my good friends, the Republicans, say it was government. Really, it was, because the government regulations forced them to do this. Well, that's not what the public thinks. The public thinks that there was collusion, that the big guys, all of you guys, were figuring out how to do this and ultimately come out ahead, as you always do. And it seems my colleagues on the other side want to help people. Now, Mr. Griffin, if I could just ask you the first question, how many people are in the room with you? You could just count how many people are in the room with you.
There are 5 people, including myself, in this room, sir, Congressman.
Thank you. So I don't think my colleagues need to help the CEOs or anybody else. They got plenty of help. Now, I have to ask this. You said that you didn't talk to anybody, Citadel Securities. Did anyone in your organization since January 1st contact Robinhood?
Are you asking if we've had contact with Robinhood?
With respect to GameStop and what we're obviously talking about.
So, Congressman, we offered to have my colleague who manages that relationship be here today instead. He has firsthand knowledge. We, of course, are talking to Robinhood routinely in the ordinary course of business. We manage a substantial portion of their order flow.
Well, I understand that, but did you talk to them about restricting or doing anything to prevent people from buying, not selling, but buying in GameStop?
Let me be
anybody in your organization.
Let me be perfectly clear. Absolutely not.
So if we depose everyone in your organization, we'll find that.
That is correct.
Okay, thank you. I do want to ask you one thing, and Mr. Sherman was pursuing this. How do you balance the best execution for the order flow from your purchase from Robinhood with the need to profit from the purchased order flow? How do you do that?
So as a market maker, we have to provide to the customer a better price than they can achieve on exchange. Order flow is routed to us on the merits of the execution quality that we provide, in contrast to our competitors who we are competing with.
Okay, my time's about to expire, but I have to say, when Mr. Tenev, when you say that you guys made $35 billion and you don't say how much your people lost on home stops, people that invested in you, that's like taking the fifth. Thank you.
Thank you. The gentleman's time has expired. Mr. Budd?
Thank you, Chair.
Recognize
yes, ma'am.
Yeah.
Thank you. And I want to also thank the panel. Now, I really care about a level playing field for retail investors to access the market. And I've been a long supporter of financial innovation and fintech and the shared goal of democratizing finance and making access to the financial system easier for all. So, Mr. Tenev, your company, it boasts that it's helping to democratize finance and is at the forefront of innovation. Can you talk a little more about what Robinhood is doing to push innovation forward and create a level playing field for all investors, while at the same time making sure that those investors are well informed?
Absolutely, Congressman. Thank you for that very important question. The first thing I should note is many of the witnesses and representatives here have stated that it's never been a better time to be a retail investor in America than it is right now. I think the combination of zero commissions, no account minimums, fractional shares, really things that Robinhood has helped make the industry standard, have helped small investors and helped level the playing field for people to participate in the markets. Over the past year, Robinhood has released fractional shares, the ability to do automated dividend reinvestments, recurring investments, so that you could take $1 or $5 and create a habitual investment into a particular stock. And the theme of this year for Robinhood is, how do we take a first-time investor and turn them into a long-term habitual investor? How do we make long-term investing accessible for people around the country? And we're making huge investments in education and customer support to support that. we recently released a revamped Learn portal. We call it Learn 2.0, with the aim of taking a customer from basic concepts such as what is a share, what is a stock, what's an ETF, all the way through to more advanced concepts. And we're continuing to invest more and more on Learn, as well as on Snacks, which is our popular podcast, and all other forms of content that we distribute. Last year, more than 3.2 million.
I want to interrupt you there. Just, I know you have a lot more things. These are great. And I know we could probably talk for a lot longer than this, but I want to shift gears just a bit. But I do want to keep talking about the retail investor. And I want to switch to Ms. Schultz. So back in December, there's an article that you wrote prior to all these events that we're even having the hearing on today. And in the article, I think that you said that it's inappropriate to refer to these very retail investors that we're talking about, that are using these platforms like Robinhood that we're talking about, and referring to those investors as dumb money. I think that's pretty insulting. And my colleague from across the aisle from Connecticut used that term. I think it's insulting. And instead, retail investors are in fact revolutionizing the stock market. So would you elaborate on those views, Ms. Schultz?
Absolutely. Thank you, Congressman. Retail investors are often referred to as dumb money by Wall Street, and it's because they don't have access to the same level of research, or some use the term because they think retail investors make dumb decisions. I think it's insulting. I think that the term needs to go out the window. Retail investors are investors who make their decisions based on the information known to them. And we should focus on educating people so that they can understand the risks and rewards of investing. Here, I think the GameStop situation is proof that the retail investors are revolutionizing the market. No one would have guessed when I wrote that article in December that retail investors were going to initiate a sophisticated short squeeze. I think the retail investors here are learning by doing, which is one of the best ways to learn. And we should spend effort making sure that people are equipped with the knowledge to understand the risks about being in the market.
Well, I appreciate that. And I would like to ask for unanimous consent to insert that letter into the record, Madam Chair. Thank you. I just want to look, Robinhood wrote about the need for, and this is open to anyone, and it's got a few seconds left, but I'd like for someone to talk about, is it possible for clearinghouses and real-time settlements on the blockchain to exist? I don't have time for that, but that's something we can come back to at a further point. And Madam Chair, I'll go ahead and yield back.
Thank you very much. And without objection, I want to make sure that that's in the record that your insertion was accepted. Thank you. With that, I'm going to turn to Mr. Gottheimer. Mr. Gottheimer, you're recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you to our witnesses for being here today. Before I begin, Mr. Gill, I read your testimony, and I'd like to offer my heartfelt condolences for the loss your family suffered last year. It's not just Melvin Capital that lost money as part of the frenzy around GameStop. Whether it is a security guard losing $20,000 or a dog walker losing a few $100s, everyday retail investors were left holding the bag after GameStop's stock fell back to earth. Not every investor lost money, and Mr. Gill, sitting before us here today, remains bullish on the stock. Still, Bloomberg reported yesterday that he was served a lawsuit accusing him of misrepresenting himself and his motivations. I'm not here today to take sides in the litigation. However, it does raise important questions about the role of social media websites like Reddit, especially in the context of volatility we experienced with GameStop, AMC, and numerous other stocks last month. Mr. Huffman, what kind of authentication exists for Reddit users to confirm their identities, to verify they're even real people?
Reddit, and this is an important quality of Reddit, so thank you for the question, doesn't require people to reveal their full identity to use the platform. One of our pillars of privacy, and privacy is something that's critically important to us, is that users should be masters of their own identity, and they can choose to reveal as little or as much as they would like. I'll point out that there are two sides of this that are really important. On one side, this allows Reddit to work. Something like Wall Street Bets would not exist if users had to reveal their full identity, because in Wall Street Bets, people are revealing gains and losses. They're effectively revealing their financial position in life, and we would not put that burden on anybody to force them to do so. I would also point out that other platforms have real identity, and it doesn't do anything to improve their behavior.
Can I ask a question of that? Is there any way for a regular user of Wall Street Bets subreddit to know what content is genuine, written by other users just like themselves, retail investors who are looking for honest information to invest on? Is there any way for that?
So there are a couple aspects to this. So the first is that we as a company invest significant resources in enforcing the veracity of our voting system. It's something we've been doing for 15 years, long before events like this, long before even the election and the politics of the last few years, where these things have become top of mind for everybody. This has been critically important to us. Also, our user base is exceptionally good at sniffing out untruths, misinformation, fake stories, both within this community and Reddit at large. And so in order for any piece of content to be successful on Reddit, it has to be accepted by that community and receive the same votes that anything else would.
Do you have any heightened standards for places like Wall Street Bets or other investing subreddits where moderators are able to manipulate content to their own financial gains?
We keep a high standard across the entire site. And in with this particular community over the past few weeks, we've been looking especially closely, anticipating these sorts of issues and questions. And to date, we have not found any nefarious behavior.
Got it. But we could have a situation where thousands, possibly millions of dollars of retail investor money may be being manipulated, right? We don't know that.
People in the United States talk about stocks on Reddit. They talk about it on TV, in magazines. People can say, in fact, they do on television all the time, encourage people to make what I would call bad investment decisions. On Reddit, I think the investment advice is actually probably among the best because it has to be accepted by many thousands of people before getting that sort of visibility.
Do you see any difference between someone on Reddit offering advice versus an analyst at a major bank or at a financial services firm?
Absolutely. I think on Reddit, you're seeing retail investors who are giving authentic advice based on their knowledge, and you would not, call into question what their motivations are or what large positions they may hold before going on TV and talking about them.
Do you plan to do more in this space, and is this something that's going to be a major priority of yours? And do you think overall social media companies like yourselves should be held to a different standard? Should you be responsible for what happens in your content? If someone manipulates something or if it's a bot, should that be on you, or do you think that's just buyer beware?
We take manipulation of Reddit incredibly seriously. That is one of our, first duties on all of this is to ensure the authenticity of our communities. Yes.
Got it. But do you think you should be held responsible if somebody posts something, if there's some collusion, or if there's somebody who it's a bot that's online? Do you think you should be on the line, or this is just a site you offer for people to exchange ideas?
Reddit can be held responsible, and we do take our responsibilities here incredibly seriously.
Thank you. The gentleman's time has expired.
Thank you. Thank you, Madam Chairwoman.
Mr. Kustoff, you.
Thank you, Madam Chair, and I want to thank you and the ranking member for convening today's hearing. If I could, Mr. Tenev, I'd like to echo what many of my colleagues have said today, and we do appreciate the fact that you've created this platform. To a large extent, you've leveled the playing field so that small individual investors can have a shot at the American dream. That's investing. Now, I do want to ask you though, and a lot's been said about the situation that occurred in late January. My question to you is, how did you misjudge your capital requirements to prevent people from being able to trade during that period in January?
Thank you, Congressman. I wouldn't say we misjudged our capital requirements. This was a 1 in 3.5 million occurrence event, one that had never been seen before in capital markets. And we had to play this by the book. Robinhood Securities made the decision that we did so that we could remain in compliance with our regulatory capital and deposit requirements. Unfortunately, it required us to restrict the buying of these securities for Thursday and limit it to some degree on subsequent days until additional capital came in that allowed us to relax the restrictions.
It was Robinhood's mistake, though, correct?
Well, Robinhood owns what happened, certainly, and we need to make sure that it doesn't happen again. But Robinhood Securities had limited options with how to address this, and I fully support the team in making the decision that they did, and I believe they did the right thing and the only thing.
I realize you said at the beginning that you're privately held. With that said, is your primary source of revenue from the order flow payments that you receive from some of the players that we've talked about today?
That is correct, Congressman. Payment for order flow is one of our largest revenue sources.
Is it the largest?
It's the largest, yes.
Now, in your testimony, in your written testimony, oral testimony, you talked about the settlement period and what we're probably capable of doing in real time, or instead of T+2, maybe even T+1. If we had real time settlement, would the situation that did occur in January, would that have been preventable? In other words, that wouldn't have happened if we had real time settlement?
Congressman, if we were to have real time settlement, and of course there's some implementation details that would govern this, there would be less of a need for collateral at clearinghouses because the cash and securities transactions would be exchanged in real time. So collateral for counterparty risk would be less necessary. So real-time settlement would lead to reduction, perhaps an elimination in some of these collateral requirements, a reduction in the money that's sort of clogging up the plumbing of the system, and that would have avoided some of these problems altogether.
Thank you very much. Just to be clear, does the same answer apply if I asked you if settlement was T+1 instead of same day settlement? Would your answer be the same?
Congressman, T+1 certainly would be better, but it doesn't. It reduces the scope of the problem. It doesn't eliminate it from a technology standpoint.
Thank you very much. Mr. Hubman, if I could, I'd like to follow up on some of the questioning that my colleagues, Congressman Hill and Congressman Gottheimer, asked. You've done an investigation into Reddit, into Wall Street bets. You don't see any bad actors. I'm paraphrasing, but you don't see any bad actors that caused any role in the GameStop frenzy. Am I characterizing that correctly?
Congressman, that's right.
You know, the Congress is looking at amending Section 230. What are your thoughts about that as it relates to Reddit?
Sure. So Section 230, I think, is a critically important law to the internet as we know it. And it was created, in fact, to protect a forum and the early internet for talking about stocks. Section 230, I think it's also important to point out, doesn't protect platforms or companies like ours from civil litigation. So there are mechanisms for coming after companies like ours. What it does protect is our ability to evolve the way we moderate our content, and in which we have done in many ways over the last decade.
The gentleman's time has expired. Mr. Gonzalez, you're recognized for 5 minutes.
Thank you, Mr. Speaker and Ranking Member, and I want to thank everyone in the committee here with us today. This is for Citadel. Mr. Griffin, in 2020, Citadel violated a regulation, SHO, which governs short selling. Citadel is now involved in another short selling problem, and Robinhood routes half of its customers' orders to you. Robinhood halts buying on a position that you're long on, and you own the hedge fund and the clearing broker. What is there to prevent you from taking advantage of that situation and making sure you profit off the confusion and retail investors?
Congressman, I'm trying to understand the question.
Let me give it to you again. in 2020, Citadel violated regulation SHO, which governs short selling. Citadel is now involved in another short selling problem, and Robinhood routes half of its customers to you, orders to you. Robinhood halts buying on a position that you're long on, and you own the hedge fund and the clearing broker. What is there to prevent you from taking advantage of that situation and making sure you profit off the confusion of retail investors?
So in no particular order, I just do not understand the reference to us owning a clearing broker. We do not own DTCC. We do not control DTCC. We are not party to the discussion, dialogue, or demands between DTCC and Robinhood. So I do not understand the premise of the question, because we have literally nothing to do with DTCC other than being a member of DTCC for providing settlement services for us and for doing real-time trade affirmation and clearing. Now, Citadel Securities owes a duty of best execution for every order that comes from Robinhood. And I will tell you that I'm incredibly proud of how seriously my team takes that duty of best execution. Some of the most earnest, hardworking, and thoughtful people that I've ever met in my life work on our retail execution business here at Citadel and take great pride in the execution quality that we give to each and every trader, not only at Robinhood, but at every single one of the retail.
Thank you for your response, Mr. Gill. But I understand that you made your position known on GameStop as far back as 2019 and are lauded as a diamond hands hero by Wall Street Bets community. Have you ever previously experienced or observed the type of restrictions Robinhood and other applications performed on January 28th?
Thank you, Congressman. No, I have not.
Thank you. That's a good question. And Mr. Huffman, I'm not a Redditor, but I do understand the problems around social media and freedom of speech and the tightrope act that goes on where these intersect. In the near decade of Wall Street Bets and subreddit, have they shown themselves to be exceptionally problematic, an exceptionally problematic forum, or just one of the many eccentric communities that call Reddit home?
Congressman, I think your latter description is more accurate. They are an eccentric community, but they're well within the bounds of our content policy. And though we do have difficult decisions to make here and there regarding specific communities, one of the things we look to first is whether the community is trying and they're putting their best efforts to be a good citizen of Reddit. And towards that end, we've had consistent communication with the moderators of that community, and they've been doing, I think, an excellent job.
Thank you. Well, the last financial crisis was caused when we turned a blind eye to the bad practices of our financial institutions. Perhaps today we've seen a warning about the clearing process, and I hope today can be a jumping off point for us to take a hard look at our markets and the practices of these institutions. In a two-day clearing process, the liability risk and potential financial stress limited trading, but in a key time in market and perhaps in a way that materially affected investors in these recent events. So I'm hoping that we all get to take a closer look at what is happening. And with that, I yield back. Thank you.
Thank you very much. Next on our list, we will have Mr. Hollingsworth for 5 minutes.
Thank you, Madam Chairwoman. Mr. Griffin, I'm going to direct my questions to you specifically, but I'm hoping to talk a little more philosophically about the market writ large rather than just Citadel itself. Certainly, there's been a significant amount of evidence supporting the advantages market makers offer retail investors. Through sophisticated infrastructure and high-speed technology, bid-ask spreads have decreased from 33 cents to less than a penny over the last 5 decades. And according to some research, saved retail investors $1.6 billion just in the first 6 months of last year alone. None of our discussion after this and the questions I'm going to ask are intended to be pejorative to that reality, but I just wanted to pick your brain, given your deep experience, about some of the implications of off-exchange trading specifically. We've seen this year that off-exchange trading has eclipsed nearly 50% of all trading. Can you talk a little bit about what factors have contributed to off-exchange trading's growth versus on-exchange trading? Certainly, I want to talk about the concerns we may have as market participants about that, but first, just the factors that you think are driving that.
I think one of the most significant drivers of off-exchange trading is that exchanges are handcuffed in their ability to fulsomely compete.
Can you talk a little bit more about that? Is this just regulatory arbitrage?
It is, I hate the word because it has a negative connotation. I believe that the exchanges should have greater latitude in setting their tick sizes in the most liquid securities. That will allow order flow that's currently going to dark pools to go to exchanges and to receive better executions. So let me just be very clear. It's not that we want to inhibit dark pools or market makers like Citadel from competing. It's that we want to enable and empower exchanges to be better competitors. I started my career as a retail investor in the day where I used to spend 25 cents in a bid-ask spread if I was lucky. I know the days you're referring to. We've come a long ways, but to continue on this journey, the next step is to allow exchanges to be more competitive in the market.
Well, so I think you answered this question, but just to put a fine point on it, there is public policy work that needs to be done in order to help resolve some of this challenge that exists in the movement of volume from on exchange to off exchange. That's incumbent upon us. It's incumbent upon regulators to find a better solution. Is that what you're saying?
Congressman, I'm saying that yes, it's legislators or the SEC. I believe much of this can be done by the SEC as a policy matter.
Right.
Think of it as the next step forward in regulation NMS.
Love it. Great. Thank you for all those answers. Just, I want to highlight this further. Can you talk about some of the challenges or deleterious impacts on the market if more and more volume is off exchange versus lit trading? Can you talk a little bit about why we should be concerned about that to make sure we all understand how important it is to make these changes to empower, as you said, exchanges to be better competitors?
I think there are three salient points I'd like to make. First, price discovery is the most important part of our capital markets function because price discovery combined with liquidity fuels our free enterprise system. It's how companies raise capital. It drives down the cost of capital. The more trading on exchanges, the better the price discovery we have. That is good for our capital markets. The second is that dark pools are often willing to engage in business practices where they discriminate against one class of investors versus another. I find it very unsettling that we in any way prohibit discrimination against one group of investors for the benefit or at the expense of another in any part of our capital markets. We want our capital markets to represent the values of our country. The third is that the dark pools themselves create a level of concern and apprehension about the integrity and fairness of our markets. And I believe that we should always be taking steps to advance public confidence and the confidence of retail investors and institutional investors that the United States capital markets are a fair place in which to transact business.
Mr. Griffin, thank you for those answers. And I would call upon my colleagues to recognize the deep experience Mr. Griffin has in these areas and how important it is that we take the steps, either via agency or via legislation, to help empower exchanges to compete on a level playing field to make sure that we create a public policy.
The gentleman's time has expired. Mr. Lawson, you're recognized for 5 minutes.
Thank you, Madam Chair, to you and Ranking Member Henry for this forum today. And I want to thank and welcome the panelists to this great forum. One thing, Madam Chair, I want to clarify for the record. One of my colleagues earlier said that when people got their stimulus money, they went and started investing it. I want to let them know that when my people got their stimulus money, they were trying to pay their rent, trying to take care of their kids, and I don't want the panel to think that when we work so hard on stimulus dollars, that happened, that that people are running out to invest their money. That's not the norm. My question, I'm going to direct it to Mr. Plotkin. Wall Street is supposed to be tied to revenue and profit fundamentals. We saw these fundamental changes when amateurs and investors gained control. They publicly stated that this isn't about investing based on their fundamentals, and that this isn't an investment about making a profit in that way. It's about making a profit to demonstrate that they can manipulate the system, and if not, better than professionals such as yourself. The rapid trade won, and Wall Street was losing billions of dollars. Melvin Capital betted against GameStop and was on the verge of bankruptcy. Clearly, there is a manipulation and distrust within the system and inequality in American finances. Mr. Plotkin, do you believe that there is manipulation, distrust, and overall inequality within American financing? And what do you believe are the consequences of big guys like yourself, but also little guys in this process?
Well, thank you for the question. I really can't speculate, in terms of the broader system. I think, Melvin, my focus is on running our portfolio and building a great organization and a strong team. I think some of the issues you speak about are much greater societally, and it's not really my area of expertise.
Okay, well, one other thing, you guys have Series 6, Series 7 license and everything, but these amateur investors don't have to go through those same standards. And because they do not have to go through those same standards, how are they able to go in and manipulate the market? Maybe someone there can answer. Over people who have been involved in this research and calculation and investing for so many years. Can anybody ask how are they able to go in and manipulate the market like this and cause billions of dollars to be lost?
Sure. Look, I think, as we've spoken about today, the financial markets are changing. There's a lot of new players. I think they saw an opportunity, to drive the price of the stock higher. And today with social media and other means, there's the ability to kind of collectively do so. That was a risk factor that, up until recently we never seen. I think, sometimes with retail investors, you think about, and they've been really adept at this, investing in the internet or software stocks or electric vehicles and, ideas with big opportunities and they chase them because they believe in the fundamentals. I think this was very different in that a lot of the meme stocks, these were businesses with real challenges, but they exploited an opportunity, around short interest and the way that was approached. And I think, us at Melvin will adapt, and I think the whole industry will have to adapt.
Well, I understand that. And so I just, from our standpoint, and I don't have much more time, but what do you recommend to us to try to keep from letting this happen again?
Look, I think to some degrees markets are self-correcting. I know, moving forward, stocks, I don't think you're going to see stocks with the kind of short interest levels that we saw, prior to this year. I don't think, investors like myself want to be susceptible to these type of dynamics. I think there'll be a lot closer monitoring of message boards. There'll be software providers. We have a data science team that'll be looking at that. Whatever regulation that you guys come up with, certainly, we'll abide by, and I look forward to, helping, if you guys want to have future conversations about that.
Okay, thank you. And Madam Chair, my time is running out, so I yield back.
Thank you very much. Mr. Gonzalez of Ohio, you're recognized for 5 minutes.
Thank you, Madam Chair. I want to thank Ranking Member McHenry for his leadership in calling for this hearing today, and also you, Madam Chair, for bringing us together. Mr. Tenov, I'm going to start my questions with you by walking through a series of events from that day in January, just to make sure we're all on the same page. So in your testimony, you mentioned that the automated deposit requirements from DTCC came in at 5:11 a.m. Eastern, and it showed a $3 billion deficit, correct?
I believe that's correct, yes.
Okay. At that point, 5:11 a.m., did you have the liquidity to meet the additional $3 billion deposit requirement?
So as we wrote in detail in my written testimony, there were a series of steps that the Robinhood Securities team took to
reclaiming my time, sir. At that exact moment, did you have the liquidity for $3 billion? 5:11 a.m.
At that moment, we would not have been able to post the $3 billion in collateral.
Okay. So when you said, and you've said this multiple times, that you did in fact have the liquidity and you didn't have a liquidity problem at that moment in time, that is not necessarily true, correct? You had to take steps to get there.
Congressman, we did have to, the Robinhood Securities team had to work with our relevant clearinghouses to adjust the risk profile of the trading day in order to meet our collateral requirements.
Right. And in order to do that, your choice was to throttle trading to prevent your clients from being able to purchase in certain shares, correct?
That's correct. Robinhood Securities had to restrict buying in about 13 securities.
Okay. And if you had not been able to de-risk the profile or the portfolio, excuse me, you wouldn't been able to raise the money, get the VAR requirement and the excess capital charge waived to de-risk the portfolio, then DTCC would have stepped in and liquidated the portfolio, correct?
I'm not sure what the exact, Congressman, what the exact steps that they would take if we weren't in compliance with the deposit requirements would be, but it would not have been a good situation for the firm or the customers.
So reclaim my time. So the letter that Ranking Member McHenry submitted for the record, I would draw everyone's attention to. I'll just read this. If a clearing member fails to satisfy a margin call, it exposes other clearing members to risk and can put NSCC out of compliance. In a case of non-payment, NSCC may cease to act for the clearing member and liquidate its unsettled clearing portfolio. So that was definitely in the cards. For my constituents who are Robinhood clients, what would this have done to their portfolio if it would have been forced liquidation as a result of missing the capital call?
Oh, well, Congressman, if there was forced liquidation, at the very least, it would have resulted in a total lack of access to the markets for your constituents, not just to the 13 securities that we restricted buying in.
Right. So this would have been an enormous catastrophe for Robinhood, correct? And the
That's
clients.
correct. And not just Robinhood, but the over 13 million customers that we serve.
Yeah, and I think that's really sort of the crux of the issue. So in a sense, I love your company because it does, when correctly managed, provide investment opportunities for individuals who are currently frozen out of the markets for one reason or another. At the same time, though, I believe a vulnerability was clearly exposed in your business model and perhaps in the regime that governs your capital requirements. And we just can't live in a world where my constituents could have their shares liquidated without their consent because you all aren't able to make a capital call. I appreciate that you were able to ultimately satisfy it, but the amount of time you have from 5 a.m. to 10 a.m. to figure this out is scary for the company, and frankly, I care more about my constituents than anything, and scary for them. And so I hope we'll continue to look at that. Beyond that, though, I also hope that this hearing highlights a very real problem with our financial markets today and how they're accessed by everyday investors. Today, the Melvin and Citadels of the world, as well as major PE and VC funds, have access to the world's greatest investment opportunities on the planet, whereas the retail investor world, of which Mr. Gill is a great member, it doesn't, for lack of a better term, has access to an ever diminishing set of investment opportunities. And so while we're debating these vulnerabilities, we're also serious about finding ways to expand access for Main Street investors. And with that, I yield.
The gentleman's time has expired. Mr. San Nicolas, you're recognized for 5 minutes.
Good morning from Guam, Madam Chair. I've been with the hearing since 3 a.m. The sun is starting to come up out here, but it's always a pleasure to be joining you in these very, very important hearings that you call for the American people. Thank you very much. I wanted to first begin by congratulating everybody who made money on the Robinhood trade. You know, you guys found a low float, low volume, massively shorted stock, and you guys squeezed it. And I think that investors like Mr. Plotkin, large money managers, probably doubled down on their short positions, thinking that they're going to win. And in the end, the massive communication networks that we have these days rallied the small to beat the large, and that was absolutely something to behold. And Robinhood made that possible. Robinhood made that possible. Mr. Tenev, you mentioned in your testimony that you've secured $3 billion in funding to address the regulatory deposit requirement situation that you faced. Where did that $3 billion come from?
Thank you, Congressman, for that question. To be clear, we were in compliance with all regulatory net capital and deposit requirements without the additional capital infusion. It was simply to provide extra cushion, allowing us to unrestrict trading and be prepared for other black swan events that might happen in the future. The capital came from mostly existing venture capital investors that Robinhood already had.
So basically, you had to further dilute your position in Robinhood in order to make sure that you secured all of your 13 million customers with that additional $3 billion.
That's correct, Congressman.
Well, that's where I have a serious concern, Mr. Tenev, because not only was your business model designed to profit off of order flow, which caused you to take extraordinary risks in having 13 million customers with access to large margin trading that facilitated the GameStop situation, but you halted buys on that stock and you allowed sells in order to mitigate the capital requirement situation, and you materially benefited from it. You materially benefited from it because it reduced the amount that you would have had to go out and raise an additional capital in order to prevent these kind of crises from reoccurring. You took from your customers in order to minimize the $3 billion from being larger than it probably would have been, because you wanted to protect your position. And that is very troubling. That is very troubling. It's very troubling that the order flow model that you built and the risk that you took on resulted in that halt. And it's very troubling that that halt also materially benefited the existing shareholders and yourself by minimizing the amount of additional capital you had to raise in order to prevent that from happening again. You basically took from the shareholders in order to do that. And that's just, I don't know what to say about that, but I think that this, Madam Chair, presents a very serious situation where we need to ensure that companies are not taking advantage of customers in this way. Mr. Tenev, you're quoted as saying in this hearing, buying increases capital requirements, selling does not. So it was something that you knowingly did. It was something that you knowingly did. It was beyond just trying to protect the existing customers. And at the end of the day, while you had to raise an additional $3 billion, it minimized that from being a larger sum. We have customers who purchased the stock who are now bag holders after the price came down because they couldn't continue going up with additional buying. And that was willful, that was intentional. So I'm glad, Madam Chair, that we've called this hearing. I'm glad that we're able to put these things on the record. And I'm just very, very concerned with the implications of this. And I really hope that at the end of the day, those bag holders get a lot more than an apology. Thank you, Madam Chair, and I yield back.
Mr. Rose, you're recognized for 5 minutes.
Thank you, Madam Chair. And thank you, Ranking Member McHenry, for holding this important hearing today. And thank you to our witnesses for your testimony and participation today and for the dedication of time that you've made to this hearing. There is still so much for us to learn from this market event. Obviously, speculation has been rampant, and I believe we should not get ahead of our skis, so to speak, and rush to policy recommendations before we understand the full scope of this situation. The committee investigation is barely underway, and I would view a large majority of the policy proposals suggested today as half-baked at this point. At the end of the day, we should all want retail investors to have access to the market and to ensure they have the information they need to participate in the market in an informed way. Mr. Griffin, my colleague, Representative Loudermilk, asked you to explain the advantages of cutting down on the settlement time, but you were cut off before you could complete your answer. Would you like to finish your thought there?
To be brief, the issue in going to real-time settlement is everything has to work perfectly in a world where there's still people involved in many of the processes. We'll get there one day as an industry. I just think it's a bridge too far in the next couple of years.
And then you were also cut off earlier when answering my colleague Ms. Beatty's question regarding the difference between payment for order flow for the options market versus the equities market. Would you like to continue that explanation?
I think we covered that reasonably well. I think the salient difference is that the options market, every trade must take place on an exchange to start with. In the equities market, the current market structure has been arrived at with the blessing of the SEC as the best way to give retail investors in America price improvement as compared to the exchanges. And to be succinct, we should make exchanges more competitive, not make internalization or dark pools more privileged.
Thank you. And then finally, Mr. Griffin, earlier Representative Lukemeyer asked about how we got to where GameStop was short sold to 140%. Given that naked shorting is an illegal practice, how did that happen given current U.S. law?
So clearly, a number of the purchasers of the short sales, of the shares sold short, are institutions that also lend their securities. And it's very important to remember that institutional investors earn substantial returns from participating in the securities lending market. So if you were lending your GameStop stock out, for example, over the period of the recent crisis, you may have been earning an annualized rate of return of 25 or 30% on the shares that you lent out. That accrues to the benefit of pension plans, of ETFs, of other pools of institutional lending that participate in the securities lending market. And keep in the back of your mind, when a bank lends money to a business, that business may turn around and lend money to its suppliers. Just because, in some sense, somebody can on-lend what they've bought doesn't necessarily mean something has gone wrong in the chain itself.
And exposures presented in the markets, the broader infrastructure of our financial markets has performed very well, I believe. My concern, like those of my colleagues, is that forging ahead with new regulations at this point would be harmful and have unforeseen consequences. In the few moments that I have left, Ms. Schultz, can you speak to what the potential dangers are of increased regulation to retail investors?
That's going to take me more than 12 seconds, but there's a lot of potential for unintended consequences here, and increased regulation can drive retail investors out of the market. It can have them have less good prices.
Sorry not to give you more time. Maybe one of my colleagues will give you a chance to complete that. I yield back.
Thank you very much. Next, we will have Ms. Axney for 5 minutes.
Thank you, Chairwoman, and thank you to the witnesses for being here today. I just want to quickly follow up with a question my colleague, Mr. Foster, asked earlier to you, Mr. Tenev. You said that Rule 606 reports detail the arrangements you have with firms like Citadel. However, those only detail the payments you receive. Are you saying that you're prepared to publicly disclose the detailed terms of your payment for order flow with Citadel and other market makers?
Thank you for the question, Congresswoman. The 606 reports do publicly detail the payment for order flow arrangements we have with Citadel Securities and our other market makers.
Okay, well, I'll look forward to seeing those details then. Will you make sure that you get those over to our committee?
Certainly, we can have that arranged.
Okay, thank you. Last month, of course, as we saw this volatility with GameStop and AMC, and the stock started to rally, everybody seemed to get involved. And one survey recently said that 30% of Americans purchased one of those viral stocks. That includes people like my nephew and his two friends who stayed up until 4 in the morning to see if they could get a piece of this action. So one of the most concerning pieces, though, of this whole episode is how many people really felt like that's what they needed to do to get ahead. To me, this just exemplifies the income inequality across America, and it's one that we need to deal with. And I do appreciate the opportunity for retail investing. I want to make sure that it creates a good outcome, however, for the people who are using it. And right now, what I'm seeing is gambling on the stock market, and it's not a real solution to that income inequality. And I don't think we should pretend that it is. Just last June, when Hertz declared bankruptcy, after that, Robinhood was actively pushing the stock on its site. It was trending on Robinhood, and the promotion of that worthless stock, I don't think is good for investors. That's a gamble that they shouldn't have taken. That's just one example. But people having access to the stock market's nice, but if they don't have the money to invest, then really it's not democratization. And that's the real reason that 80% of the stock market's owned by 10% of the people. And of course, those are people who don't have to put all their money into healthcare or childcare or a car payment or whatever it is that's just keeping them going through their day-to-day. Earlier, Mr. Tenev, you said that you couldn't tell us what your client's rate of return is, but generally 99% of short-term traders underperform the market. So, Mr. Tenev, you say Robinhood's mission is to democratize finance. Is that correct?
That's correct, Congresswoman, yes.
Okay, so I want to ask you then, you've invested significantly in behavioral research, and just so you know, I own a digital design firm with my husband, so I'm familiar with what behavioral research can do for platforms and websites. And that behavioral research has really shaped how your app is designed. Is that correct?
Congresswoman, like many technology companies, we employ data scientists, user researchers, and designers to provide a better customer experience and understand our customers' needs.
So on the specifics, when people sign up, they get a scratch-off ticket to see what they get. Confetti falls every time they place an order. They get push notifications. They're encouraged to trade. If a friend signs up, they get a free stock, on and on. Why have you added specific gaming design elements to look like gambling to your app? That encourages more frequent trading.
Congresswoman, as I mentioned earlier, we want to give people what they want in a responsible, accessible way. We don't believe in gamification. We know investing is serious, and that's why most of our customers are buy and hold. A very small percentage of our customers utilize margin.
Well, I appreciate that, but folks like my nephew actually aren't your customers. They're your product. Your customer's sitting right next to you, Mr. Griffin, with Citadel. So when you don't pay as much for index fund or Apple or anything like that, your app to me shows me that you're really just trying to encourage more trades, which puts more money in your pocket, not helping people build equity through smarter investing. So I would ask you, Mr. Tenev, I'd ask two things. Who exactly do you believe you're democratizing finance for, and how do you plan to address these conflicts of interest?
Well, first of all, I believe in our business model, Congresswoman. I believe our business model has become the industry standard for a reason. It's because it's good for customers. It's led to the democratization of the markets, and it works. And we're very proud to route to market makers on uniform terms without taking into account any of the payments that we generate from them in the routing, and based purely on the execution quality they provide to our customers.
Mr. Sile is recognized for 5 minutes. Thank you.
Thank you, Madam Chairwoman, and thank you for holding today's hearing. I'm concerned about investors in the state of Wisconsin and across our country to make sure that they have access to the market, access that is fair and equal to the big banks and the hedge funds in Wall Street. And we've seen great improvements in access, the democratization in finance. And I'm concerned that these hearings are going to lead us down the path of additional regulations before we fully investigated the facts. It was stated earlier that may not be the case. And I'd like to have inserted into the record a Bloomberg article dated January 28th titled GameStop Trades Show Need for More Regulation, Democrat Says.
Without objection, such is the order.
Thank you. I think it'll be helpful for everyone to review that, with the concerns being that we're going to drift away from the democratization of our finance system. Also, a bit disappointed that we don't have representation in our first hearing here today from the SEC or the DTCC, especially in the early days of the Biden administration. I think that that would be helpful, and hopefully we'll be able to have their participation in a future hearing. If I can direct my first question to Mr. Gabe Plotkin at Melvin Capital Management, there's obviously a lot of attention that came pouring in on a stock, GameStop, that you held a short position in. People were tweeting about it, things were building. Do you have any information as to uniquely why folks on Twitter and on Reddit and others uniquely targeted that stock?
First of all, thank you for the question. I think it's a really good one. I think ultimately, I'm not sure kind of how the momentum built around that. There were certainly some signs, as we kind of diligenced after the fact. I mean, there were even website names bought, like, nasty things about our firm as far back as November. So I'm not sure kind of how it started, but I think ultimately they saw an opportunity with a very high short interest stock that a lot of people could relate to, because it was a retail experience, and that's sort of the genesis of it.
Thank you very much. I'm going to shift gears over to Robinhood and Mr. Tenev, if I can. Is my colleague Mr. Gonzalez was talking about, at some point it became clear that additional collateral would likely be needed. How many of your customers owned GameStop stock or options on January 27th?
I don't have the exact numbers.
Suffice it to say, had it increased? Suffice it to say, had it increased dramatically over the days leading up to the 27th?
Yes, that's accurate.
Fair. And you saw additional order flow coming into this. Did you take any steps, and was it reasonable to believe that there would be additional capital requirements? And did you take any steps, either internally or working in concert with the National Securities Clearing Corporation, to mitigate the risk posed by the volatility before the January 28th collateral call?
We did. So on January 21st, we went to 100% market requirement for AMC. And that requires all purchases for those stocks to be fully paid for. So customers would have been unable to use margin to buy those. So that was January 21st in the case of AMC, and January 26th for GME.
But this was still insufficient ultimately as related to the collateral call that came in the early morning hours on the 28th. Is that correct?
That's correct. The limiting margin was ultimately insufficient.
And as you look to your peers, do you know any other brokerages that were putting in place limitations on their buy orders?
Yes, I do, Congressman. I think that's an important question. Many brokerages put in place similar limitations on buy orders for many of these securities.
For the record, I've heard conflicting reports on that. I think it's something that this committee needs to further look into, is to the differential between what occurred under your control at Robinhood and some of the other brokerages. I think it's a question that we should fully investigate on this committee, make sure we have all the facts as we're moving forward. Could you detail, Mr. Tenev, your plans going forward as it relates to making sure that an event like this doesn't occur and that you have the foresight to prevent these late collateral needs?
Absolutely, Congressman. Thank you for that important question. Certainly, the additional $3.4 billion helps provide a significant cushion. In addition, you could see that between Thursday and Friday, Robinhood replaced the PCO, which was a position closing only setting, with much more granular position limits.
Congresswoman Axney.
I'm sorry.
Please, the gentleman's time has expired. The voice that you heard had nothing to do with what you were saying. I think it was a mistake. With that, the gentleman's time has expired, and we'll move on to Mr. Caston. You're recognized for 5 minutes.
Thank you, Madam Chair. Thank you so much to our witnesses. There's a whole bunch of themes in today's hearing, and I want to, if I can, just tie a couple threads together that I think are relevant that we've had corners of. June 2020, Alex Kearns, who was 20 years old at the time, from Naperville, Illinois, killed himself, largely thanks to a bug in the Robinhood system. The bug was that he turned on the app, said he owed $730,000 that he did not have because of options positions that he thought canceled out but didn't appear to. He called the helpline. The helpline, of course, was not manned, as we've discussed. He sent several panicked emails, 3 to be precise, did not receive a response. Ultimately, there was a response from the email saying that, in fact, his positions were covered, but by that point, it was too late because he had taken his own life. This is a gentleman who was 20 years old. Under Illinois law, he was not allowed to buy a beer, but he was allowed to take on $730,000 in positions and exposure that he did not have the liquidity to cover. Now, your mission, Mr. Tenev, is to democratize finance, but the history of financial regulation is to protect people like Alex Kearns from the system. As the old joke goes, if you're playing poker and you can't figure out who the fish is at the table, you should leave the table because you're probably the fish. And there is an innate tension in your business model between democratizing finance, which is a noble calling, and being a conduit to feed fish to sharks. I want to cover a little bit of timeline. December 2019, Robinhood was assessed a $1.25 million fine by FINRA for failing to disclose payment for order flow agreements to your customers. 6 months after that, Alex Kearns committed suicide. 6 months after that, December 20, Robinhood paid a $65 million fine to the SEC for, among other things, failing to disclose payment for order flow agreements to your customers. There's a tension in your model. Now, along with that, according to your 606s, as been reported by CNBC, you attract a higher rate for equity trades from payment for order flow from many of your competitors, 17 cents per 100 trades versus about 11 cents for your competitors, even more, over 50 cents per 100 trades for options. I'd ask unanimous consent to enter the CNBC article into the record.
Without objection, such is the order.
Question for you, Mr. Tenev. When did you start offering options on your platform?
Thank you, Congressman Caston. And first, let me say,
I'm just looking for a date. We're tight on time. When did you start offering options?
Options trading was offered starting in Q1 of 2018.
Okay, thank you. That's relevant because prior to 2018, your revenue grew basically linearly with user growth. Your revenue any year for your payment for order flow interview was about $10 per user per year. 2020, it got to $50 per user per year. So your revenue model went from growing revenue by growing users to growing revenue by growing revenue earned on the back of each user, consistent with taking on options. How many firms do you route options orders to, Mr.
Tenev? Congressman, we have 7 market makers. I can get back to you with the precise number for options under 7.
According to your 606 disclosures, you only list 4: Citadel, Susquehanna, Wolverine, and Morgan Stanley. Are there any others besides the ones listed in your 606 disclosures?
If that's in the 606, Congressman, I'm sure it's accurate.
Okay, so do you route options trades to anyone who you do not have a payment for order flow agreement with?
Currently, we have, Congressman, uniform payment for order flow arrangements with all of our market makers. So they would all be under the same arrangements.
Okay, so how do you ensure that you're getting best pricing if every single firm, you're ruling out anybody who is not paying you for the privilege to trade?
Congressman, we believe having uniform payment for order flow arrangements with all market makers ensures structurally that there is no conflict of interest, because it prevents payment for order flow from being an input in decision making for where to route orders.
Okay, I'm almost out of time, but there is an innate conflict in your model. Let's imagine right now that we are today's version of Alex Burns. I'm nervous. I think I've got an exposure, and I call your helpline now. Let's call and let's listen in the time we have remaining to what I'm going to hear on the other end of the phone.
Thanks for calling Robinhood. Please visit us at robinhood.com or on our app for support. If you have an urgent trading need, please make sure to include details of your order when reaching out. Thanks and have a great day.
Mr. Caston, you may wrap up.
Back my time.
You may wrap up. Go ahead, Mr. Caston.
I have no further questions, Madam Chair.
Thank you very much. I will now call on Mr. Gooden for 5 minutes.
10 minutes. 10 minutes.
Is Mr. Gooden on the line?
Madam Chair, Mr. Gooden's in Texas and he's unavailable to.
Oh, thank you. Thank you very much. Then let us hear from, I believe it would be at this time, Mr. Timmons. For 5 minutes.
Thank you, Madam Chair. It seems we're here today to try to find culpability in the events that transpired last month. I seem to spend a lot of my time thinking about capital requirements and the time it takes to execute these trades. So I'm going to focus my questions there. Mr. Tenev, you have repeatedly invoked capital requirements that both your company and your clearinghouse are required to abide by in order to explain the restriction of trading last month. My friend and colleague, Mr. Barr, asked you about this earlier, but I would like to hone in on this a little bit. Could you explain what specifically about the nature or volume of the trades being ordered by your customers caused these increased capital requirements to be triggered? And how did the level of collateral required compare to what you would normally have to abide by?
Thank you for that question, Congressman. So to give you a sense for the increase, our capital requirements, our deposit requirements with NSCC from January 25th to January 28th, so a span of 3 days, increased tenfold.
What is the most your capital requirements had been prior to this event?
I believe there was a table, Congressman, that I provided in my written testimony that had the precise value at risk and special charges in the prior days. Happy to refer
But obviously
to that.
it never been close to this amount, and now you have additional capital that you've raised, and so this should not happen again. Again, I think you referenced 1 in 3.5 million was the likelihood of this situation occurring. Is that correct?
That's correct, and that's not a Robinhood number. That's actually a third-party industry number.
Are you aware of the origin of these capital requirements?
I do believe that these capital requirements, and specifically the NSCC deposit, was spelled out in Dodd-Frank.
So the Dodd-Frank Wall Street Reform and Consumer Protection Act is arguably to blame for what happened. You would not have halted trading in this case, but for this exorbitant capital requirement that you were unable to meet. So I think that when we're searching for culpability, we need to realize that the well-intentioned legislation from over 10 years ago is somewhat culpable in this entire conversation. Ms. Schultz, will you elaborate on that? Do you agree that Dodd-Frank is somewhat responsible for the situation that Robinhood found themselves in?
I think the capital requirements in Dodd-Frank can be seen as responsible. I think it's incumbent on us to evaluate those capital requirements and whether they are appropriate given the business models at issue. I think that's also a question of settlement times and modernizing our system. But I agree that the capital requirements here put into place are one of the reasons that we're having these conversations today.
And you went to the next place I wanted to go, which is the time it takes to settle these transactions. So, 12 years ago, 10, 11 years ago, we never really considered the whole concept of a Robinhood, of an app-based trade platform that democratizes access to purchasing and selling publicly traded companies. So I do think that that needs to be revisited, especially because it is unfair. There are other companies that have far more resources that are not in the situation, and those companies have larger investors. So we really are picking on the little guy in this entire conversation. So between reconsidering capital requirements for retail investor platforms, number one, and number two, trying to find a way to settle these transactions faster, those two things seem to be the best way to achieve our objective of making sure this doesn't happen again. I do hope that we can hear from Michael Bodson from the DTCC in the next hearing, or perhaps someone from the NSC. I'm hearing something strange on my computer. I'm sorry, one second. Thank you. I'll end with this. One of my colleagues across the aisle said the deck is stacked against the little guy, and I couldn't agree more. But in this case, the very committee that is conducting this hearing has more culpability, I would say, than any of the witnesses that we have brought before us today. So we need to make sure this doesn't happen again. I look forward to working with my colleagues across the aisle. With that, I yield back. Thank you.
Time has expired. At the request of one of our witnesses, we will take a short recess. The committee stands in recess for 5 minutes.